Yeah. All right, we are live. What's up, everyone? Welcome to the Weekly Jargon. My name's Abel Perez,
Rohi Zachariah.
and we are here together, a duo today. Typically, we're a trio, but Jose is out on vacation, hanging out, drinking, and playing golf, probably. No, I'm just kidding. He's in Sacramento attending to some city affairs.
There you go.
And so we wish him well over there, and hopefully he's able to bring back some knowledge and some grant money for
There we go.
new parks and all the good stuff, right, here in the city. So shout out Jose Rodriguez, Councilman, Madera, California. Call him if you have any complaints. So, Rohi, what are we talking about today?
Yeah, I mean, I saw an interesting article coming up about California wanting to increase the tax on these people flipping homes.
Yeah.
And it was just interesting because obviously with you guys being the housing and stuff and housing being
Right.
hot. It's just I hate the word tax. So
Yeah.
when I see that, it was an interesting topic. So.
Well, I'm sure nobody, the people who hate it especially are those home flippers, right?
yeah.
Now, home flipping is almost like it's become something that is accessible to anybody now, right? Anybody could be a home flipper, and I think we have HGTV and all of the Netflix shows to thank for that because they've kind of packaged it into, hey, this is how you do it.
Yeah.
There's a lot of instruction, a lot of TikTok videos out there, YouTube videos that talk about how anybody could essentially be a flipper, right? And so a lot of people are making some serious money on it. There is a lot of money to be had. And of course, with just like any other investment, right? There's always risk involved,
Sure.
and there's times where you got to watch yourself, but. It almost seems like any time the good old Uncle Sam starts seeing anybody making some good money, it's like, how do we get more of that,
Yeah.
right? And I don't know. What are your thoughts? What are your initial thoughts about it? Is it a good thing?
Well, I mean, I mean, if the idea is to suppress like this, if they're seeing it such a bad thing,
Yeah.
I mean, I don't like when that's the approach. I don't like when they say like, hey, we don't like this going on, so we're just going to tax you more so you
Right.
stop doing it. I think it's like you said, it's this has come about on its own thing, right? There's people buying a distressed house for a really good price.
Right.
It needs a lot of work, whether they're able to do it themselves or they're just kind of figure out what needs to really be done versus what they could do.
Right.
And making a profit. I mean, like every business that's their business model, right? You buy something cheap and you sell it for something high. And,
Yeah.
So to penalize them, this market specifically,
Yeah.
doesn't seem right.
We're located here in Madera, and Rohi, so you'll be familiar with the like Thomas Jefferson neighborhood, right? And I use this neighborhood all the time because this is a neighborhood where the homes are 40, 50 years old now. Some are a little bit older than that even. And these homes, this neighborhood, 10, 15 years ago, it was pretty run down, right?
Yeah.
It was, no disrespect to anybody who lived there, but if you did live there, you saw the foreclosed homes,
Yeah.
the overgrown yards that, some had no grass. But then what you had these people, these opportunists who came in and said, okay, we are going to buy that house. We are going to take it off the market and we're going to flip it because also, thanks to HGTV and Netflix, they also taught us that, man, with a little bit of TLC, a small old house could actually have, those have the most character and could be like the nicest homes, right?
Yeah.
And so they started doing this, and what you've seen was this total revitalization of that entire neighborhood. Right. And so as I go through there, which I do every single day because my son goes to school there or in that neighborhood. So I'm driving through and I'm taking all the back roads to, beat traffic sometimes. And I'm what I see is just the majority of homes well groomed, well taken care of. And, I'm fortunate enough, like you mentioned, to be in the industry of, providing home loans for people. And so I know several people who've recently purchased, and it's like, man, look at, they're keeping up their yard.
Yeah.
And, there's, they're garaging their cars or, or their cars are parked in the correct direction in the driveway, right? Just
Yeah.
little things like that. They're not parked on the grass and driving up to the front door. But you got, a combination of a couple things happening. One, you entice people to come here because a flipper decided to renovate the house, make it something that attracted people to go there. Thanks to the affordability of that home, the age and everything like that, or thanks to the age and all of those components, it's made it more affordable than a newer home or whatever. So it, you get these people that come in, but it's still, the housing market is still very healthy. It is expensive to buy still, relative to when your parents or your grandparents bought, right? It's still a significant investment. And so you end up with there's a correlation between people who are buying homes and the quality of life that they like to live. So they're people that are able to maintain their homes, right?
Yeah.
So I guess my point is, like, man, these flippers are doing some justice for communities by allowing them to be revitalized. And sure, they're going to make a profit because somebody has to, right? The government, we sometimes, I think we want the government out of everything, but then when we look at distressed cities or counties or housing or buildings, we say, why doesn't the city council, Jose Rodriguez, why isn't he in Sacramento trying to fix that building?
Yeah.
Well, that building's owned by a private entity, right? So why would the government pay for that private, that individual's, upkeep, right? And so if you have people who are willing to invest in your community, I just have a problem with deterring them to do that, right?
Yeah.
Now, you made a good point. Like, anytime the IRS or whoever decides we want to create a deterrent, they add a fee to it, right? Or they add taxes to it. Why don't we, instead of doing that, why don't we do something proactive and create regulation on it, right? Rather than cost. And we say, Rohi, we appreciate you wanting to revitalize our community and buy these houses and flip them and make a good profit, right? We want you to keep making money. We're blessed to have you, right? Yeah. But we don't want you to sell lemons to the community, right? We don't want people to buy a home that had a great paint job and everything underneath that paint was garbage, right? The wiring was old, it wasn't brought up to code, and 2 years from now these people are having issues, right? So I would argue that, if an investor is purchasing a home and there's, a flip, maybe something where the city or the county, depending on where the home lies, has like audit periods of the renovation.
Okay.
In addition to your typical, building permits and things like that. And maybe this would create a expectation that, okay, Rohi, you're a first-time home flipper. I'm glad you watch HDTV, and I'm glad you bought a new tool belt at Lowe's, and you have ambitions on doing this, but you got to do it right. And you got to hire the right people, the true professionals, right? Because you're not an electrician, so we don't want you going over there changing outlets to Bluetooth outlets and wiring things wrong and causing issues for these people down the road, right? That would be my approach.
Okay. Well, and here's where I would agree to some point. So if you look at other industries, for instance, cars, right? If I want to go buy some car at the auction, right, for crap because maybe it was in a wreck or whatever it was, right? Yeah. Me as the individual, I buy it, I take it home, I fix it up, whatever I do, and knock out the dents, get the engine running because, like you said, maybe I do my own mechanic work, and I sell it in a week. There's none of that. Now, if I sell too many of them, the state will come in and say, what? Well, you have to be a dealer. Right? You have to be a dealer. That's the penalty or the regulation, like you would say, is like, hey, we've noticed you've sold more than, I think it's like 6 cars you're allowed to sell a year or something like that. Now you're a dealer. And if you keep selling without the dealer light, there's your penalty, right?
Right.
Now it doesn't address the issue you're saying of like, maybe I'm not really a good mechanic and I didn't really know how to fix the engine and it blows up a week after I sell the car. But that's kind of, I guess, when you're buying a used car from some random dude, that's the roll of dice,
right.
Same thing with my gun industry. People buy and sell their own guns all the time. Feds say you can only sell 6 until you become a dealer, right? But we don't, like, California didn't look at this last couple of years of gun sales and go like, man, people selling their private guns and flipping them, we need to somehow charge a tax on that.
Right.
Like that didn't exist.
Right.
So that's where it's confusing. Like I would say yes, like there should be a point of a house flipper getting to a point where you have to have some kind of licensing, but it's odd because they're not usually the seller of the house, right? They go back to somebody like you. I fixed up the house, Abel, here, can you sell it for me,
Yeah,
right? They're
yeah.
not also sticking the sign necessarily out front and listing it and selling it themselves. So that's where I kind of have some of that. Now, I believe, because I don't know the home market like you do, but I mean, if I go and I do fixing on my home when I sell it, I mean, isn't that part of the whole home inspection that somebody is supposed to come and somehow give authority and say, yes,
Right.
we believe the piping is good, the electrical's good.
Right. There's no sign of this. Right?
Yeah, there's no mold, the roof
Yeah.
looks good. Like, so there is some of that regulation kind of already baked in.
Yeah.
You know, so that the buyer obviously has some kind of protection if a week later it burns down or there is a leak in the roof, that they have some kind of protection. But
Right.
me as the guy who happens to get a good deal on a house, fix it up in a couple of months or 6 months and flip it, like I do it once and all of a sudden now there's a 25% fee on my profit. Like,
Yeah.
you know, so I would agree that at some point it would probably have to be a new license because, you know, I'm not a seller, so I don't need that like agent kind of idea. But
Yeah.
somebody who is a frequent flipper or seller of
Right.
homes, I would say, yeah, maybe there is a mark that says after your 5th home or 6th home, because that seems to be their magic number. They like a
Yeah.
6. You know, if you flip more than 6 in a year, you have to have this special flipping license, you know.
Right.
And with that comes the need for some kind of insurance or
Insurances,
guarantees,
yeah.
you know, on what you're doing, because you're a business, right? I mean, that's essentially at the end of the day,
Right.
what all of these agencies are trying to get you to understand is you flip your home one time for profit, you're a normal person. If you flip it for 6 times, you're a business.
Right.
And that's kind of the angle.
You know, and that does make sense because, you know, at that point you really are a business,
Yeah.
right? You really are a business, and just like any other business, we would expect some type of warranty, right?
Correct.
A warranty on your work. You're telling me
Consumer confidence is the technical word.
Absolutely,
Yeah.
yeah. I mean, because that's exactly what you're doing. You're installing all this confidence during the sales of it,
Yeah.
right? You're selling it on the premise that, hey, we replace this,
Mm-hmm.
we fix this, it has new this. Okay, great. So then, if it's all new, then you know, are you going to give me 5 years on all of
Yeah.
that? Whoa, well, I don't know. Anything could happen. What do you mean anything could happen? You know, like,
Yeah.
you know, technically you should be giving me 20 years if these things are new, right? But you know, but some type of insurance like that, and now that home flipper may have to have a policy in order to back them or protect them if they don't want to come out of pocket every time a claim is filed, right?
Yeah.
Now, of course, you know, I'm not too big on regulations when it comes to, you know, things like that, but it's almost like it's going to happen anyway, right? There's already an article saying that this 25% tax is going to happen, and but it is frustrating when the concept is let's just enforce a tax
Yeah.
on every single buddy, and it almost seems like, you know, especially here in California, there is this very obvious attraction to home equity, and this very obvious attraction to you know, getting a piece of this real estate industry because it's so giant, it's so big. I mean, you don't talk about finances without reverting to the housing market, right? Because it's just that infused into everything. And so, you know, we see like programs like the California Dream for All program, right? Where it is an equity share program. It's California saying, hey, we're going to front you this money, but guess what? We're going to take 20% of the equity or the appreciation between now and the time that you refinance or sell, right? It is a great program. It does solve a lot of individuals' problems, which is money available for down payment, you know, a lower mortgage because, you know, you're putting so much down payment down. But it is essentially, at the end of the day, it is a grab of equity from California, right? There is a lot of incentive for them to be able to provide this, right? And so, you know, you combine that with something like this initiative where it's like, well, now we want to not only get the first-time home buyers, but now we want to get the investors as well, right? And we want additional money. And I will say, you know, capital gains is already quite significant for these home flippers, right? And so if you're somebody who's considering flipping a home out there, you know, you do have to expect to pay capital gains on this. Now there's 1031 exchanges and things like that you can do where if you sell an investment property, it allows you to take those proceeds and buy a new investment property. And so you could, reinvest that money and continue to kind of snowball it. But ultimately, when that money gets withdrawn and parked in your account for spending, you're going to pay a tax on it that's already significant. And now, potentially an additional 25%.
And I know with housing, it always seems like the 2-year mark, if I'm right, like the first time buyer, is that that's a thing, right? Like you're a first time buyer as long as you hold the house for 2 years and you go buy a new one. Is that
is that
the correct way to?
So a lot of the agreements on the disclosures, you're agreeing to occupy the property within 90 days. And then you're to occupy it for at least 12 months, right? And so, but there are audits of loan applications, and that's typically how they discover this. So, like the whole primary residence versus investment property, it's only been a big deal to banking regulations, right? Because there is a discount on the rate that you receive depending on the occupancy status. If it's a primary residence, then you're typically going to pay a lower rate versus an investment property, right? So you're paying a premium on that rate. Now, if you're defrauding the bank by telling them that this is your primary residence, then you're essentially taking money from them, because an investment property, they're assuming more risk, right? I mean, if the going gets tough for anybody out there, you're always going to pay the roof that's over your head.
Yeah.
You're always going to pay that bill before you pay for like the one that you can't see and you're not, standing under right now, right? Oh, well, I got my house in Chowchilla and I'm gonna let that one ride and maybe go into foreclosure and but I'm gonna keep this one, keep the lights on here because I'm here. My kids are here. So banks know this. They know that there's more risk associated with those investment properties, and so there's a higher premium to pay on that.
But I mean, like as a buyer, so let's say I'm in my home. It's 2 years, right? I think is what you got to stay.
Yeah.
Right. So I stay the 2 years. I go buy my next primary home. I move into it, but I keep the old one, turn into a rental.
Yeah.
Right. Stay in the new one for 2 years, and I go buy the next one. Keep that one. The banks don't come back and say, hey, we noticed you moved.
No.
So they can't come back on that,
No.
right? So you're always kind of getting the primary home
correct
rate.
Correct.
But
yeah, and I think that's part of our license as loan originators. We're required to report, but mortgage fraud like that if we suspect that's occurring.
But is that fraud? Is that fraud?
Not if they meet the terms of those minimum occupancy terms, right? So it's not. It's hey, you met it. Life happened. You're upgrading. You're moving. You have a taste for new houses. Like
I don't have to sell my old house,
and you don't have to sell your old house, right? Yeah. But then what ends up happening though is you do have to have record of profits on those houses, right?
Mm-hmm.
So otherwise you're going to have a hard time qualifying for that next one unless you're just really wealthy, right? So the average person might have a harder time like by year 6, buying their, fourth house or third house or whatever it might be, because now they have to cover the mortgages for all of that stuff. So obviously, you're filing a Schedule E, which is the your tax form for your profits and showing your rents and offsetting your mortgage, and that's going to help you be able to continue to keep your debt to income within range of buying a new home.
Okay.
So, but no, there wouldn't be any red flags thrown up there. The red flags are thrown up when you buy a house in January, that's your primary residence, and then October you're buying another house, that's your primary residence. Not technically an entirely red flag, right? But it will require a letter of explanation.
Okay.
And that's going to be just me saying, hey, Rohi, why are you buying a new house after, only 8 months?
Okay.
And you're going to say, oh, because, my wife's pregnant now and, we bought this 2-bedroom, 1-bath, but we're actually having twins, so I need 4 bedrooms now or 3 bedrooms, right?
Okay.
Okay, cool. You give me that letter, it's in the file, right? So Fannie Mae, if it's a conventional loan, Fannie Mae is going to have that, and it's going to be in that file. FHA will hold that in the file via all of these regulatories, right? So now when you come around the next year and in March, now you're buying another one, that lender might ask again, no, Rohi, why are you buying this again, right?
Yeah.
So now at that point, Fannie Mae could choose to audit you, right? Now, I think the trick, if you were trying to play the system, was you would definitely go to a different lender each time, right?
Okay.
You wouldn't want to come back to me because I'm going to say,
Taking that down
hey,
from my
bro,
notebook.
yeah, I'm going to say, hey, bro, like, you keep giving me these excuses,
Yeah,
right? And our underwriting team is going to say, hey, look, we have in our internal files that this is happening, so you're just going to get caught a little bit faster, right?
Okay.
And we're going to say, hey, we apologize, but you're buying this, third home. It doesn't make sense,
Okay.
we do have to note this, right? And it would be up at the discretionary of that management team, that underwriting management team, to decide whether or not they want to, continue with that.
But the penalty being that you lose the primary home rate is basically essentially.
Correct.
And what is that rate difference? What does that really?
So it could be about a
Okay.
point different, point and a half in some cases, depending on credit score, and it is a significant difference.
Does it help that if I have, like, for instance, the home that I'm currently in selling, like I'm looking to sell that home to buy this new home? Is that something they're considering as well? Or?
Well, so then that would alleviate that aspect of it, right? Because you're no longer retaining that property. So on your
But if I buy the new home and I don't sell the old one, I say,
correct.
oh, I get
Well,
to sell.
you're retaining it,
Yeah.
right? So now, if that property sold prior to the purchase, well, then again, in our explanation for what you're doing, right, we can show, oh, well, I don't know. He wanted a new house. He sold this house, so it's not like he has this whole portfolio. And on that 1003, which is the application form for a residential mortgage, it under the real estate owned section, that question is asked, right? What are you doing with this property?
Okay.
It lists all the properties. What's the intention with it? And then there's profit that's infused in there, and we go through that whole thing. So everything is pretty well documented when it comes to that. But it happens all of the time, right? I was actually reading disclosures with the borrower about mortgage fraud, right? And so that would be considered mortgage fraud, saying that you are occupying a home and you're not actually occupying it as your primary residence, right? And it says up to it was the first offense was like $1,000 fine, up to like 30 days in jail, right? And so there are fines, and they progress as you continue to violate them, right?
I mean, again, I know houses and cars are always, it's a different animal, but it's like if you go back to cars and you applied that same principle. This is your third car you're buying, so therefore it's not your primary car. Are you going to show that you drive more miles on, like, it just, so the logic doesn't make sense. I get what you're saying, like the guarantees and like.
I guess there's not a difference in rate with cars. There is.
Yeah, like my fifth car. I mean, they're going to go look at my income and my debt to income ratio, but they're not going to say, well, this is your sixth car, so we can't give you this special rate that you did on your first car. Like nobody's offering a first car buyer's incentive, right?
Yeah, and I would argue the terms are just a lot different, a lot shorter with automobiles, right?
Sure. But a
versus,
higher risk, cars
home.
lose value. The minute you drive it off the lot, my home's gaining value. So it probably gained that 1% in the first 6 months I held it. I mean, in a normal market, I guess, you know what I mean? Like,
so and I tell people this all the time, like, banks are no longer in they should never be or never were, but we're not in the business of trying to get you to fail on your mortgage so that we can have this house and then resell it, right? You would think that would be a pretty good thing, but obviously the housing bubble kind of proved that could be a very risky thing at the same time.
But that's what the car industry does. So when you have that down payment in the car industry, that's the dealer's guaranteed money. So if you default, they've already got their cash. And I always feel like when you're in the home market, you're doing the same thing, because I'm coming up with a huge amount of money when I buy that home. It's cash money that I'm putting in. So if I default, the house didn't, like, in that 6-month window, didn't lose $20,000, $30,000, right? Right. Like that was free money to. So I mean, again, I would argue the opposite. I would say if I'm a bank or whatever, okay, Abel, give me your $30,000 down payment. I hope you default tomorrow because I'm going to sell it to the next guy and get another 30. And I'm going to get another, and I can make the whole house in a year, right?
Right.
Just you defaulting and selling it to the next guy. So that's where, again, I get it. Yes, the housing could crash tomorrow and cut in half like it did in 08, but or 06.
And I think with, and I don't know the specific, regulations that are implemented on mortgages and banks, but, predatory lending would be, one of the aspects of guideline that I know is enforced, right? We
It's not
can't
enforced.
we can't prey on, and that's the reason why, the CFPB back in 2013, established all of these regulations for lending, right?
Yeah.
You have to verify income. You have to make sure that these
'Cause
people
that's what happened in
can actually
06, 'cause
qualify.
you
Yeah,
didn't
correct.
verify, but
Right.
it's still happening.
It can, yeah, for sure. And and again, I'm not saying it's perfect, but I know that these regulations, it repositions banks or it enables the ability for banks to have that mentality where it's like, yeah, I want you to default, so that we can,
But I
prey
feel like-
upon you, take advantage of you, and because there is huge money, because it's not just. Let's take an FHA loan, for example. It's not just the 3.5% that I'm getting from you, because that would be your down payment, 3.5%. You're paying mortgage insurance, and what does mortgage insurance do? It protects the bank, right? So if you default with an FHA loan, I'm not only going to get your 3.5 that I already collected, but the mortgage insurance company is also going to pay me the other 16.5%. To make up that variance, because 20% is the norm, the standard initial investment requirement, right?
Yeah.
So back in 1930, right, when FHA was established, that was the whole model. It's okay, people can't afford 20% down. Let's create this 3.5% model, and banks are saying, well, we ain't going to do that. How do we? How do we force banks to be able to be comfortable with that? Well, we'll create this mortgage insurance entity that. Yeah, we'll guarantee that additional 16.5%, or meet the difference between whatever is put down and 20%.
Yeah.
And so that kind of I guess beefs up your argument where it's like, man, banks could be making a killing, especially right now, if people were defaulting, and the quicker that they do it, the bigger their profits, right?
Because I see it in the car. That's why I'm saying,
Yeah.
like you say, you can't do it in homes, but I see it in cars all the time.
Yeah.
Because again, I've had employees or previous employees who are trying to get car loans, and I'm like, well, for one, they don't work for me anymore, so they're lying that they even have a job.
Right.
But I mean, this last one, it blew my mind, because I'm sitting here telling this I can tell it's the car dealership that, like, look, this person does not have a job right now, and they still gave that person the car, because obviously, like I said, they probably got a $500, maybe $1,000 down payment. They know the person's going to default on it. If they don't, they already know they're high risk, so they probably gave them like a 14% or something crazy,
Right.
interest rate, right? And then they just know, okay, fine, you're not going to pay it. We'll get the car back, and we'll sell it again, and we'll get the car back, and we'll sell it again.
Right.
You know what I mean? Like, that predatory side, I think, does exist in those markets.
Yeah, and I think the economy hasn't, the auto sales industry hasn't ever affected the economy quite like the housing market does, right?
Yeah.
And so the influence that it has on the economics of the nation are a lot different, and so I think that housing would be a little bit dangerous if it did have that market. And I think 2006, to your point, was 2006 2008 is a prime example of that, right?
Yeah.
Where it's like, well, okay, people are defaulting, like, perfect. Let's we're making all this money. At that time, homes were appreciating at a rapid rate, right? But then we just so happen to have this perfect storm with the Great Recession and the housing bubble occurring, at the same time. So then you had just this influx of foreclosed homes or people just not paying their bills. And then you have individuals who can't afford to buy a new house because now we have job loss and we have job cuts and things of that nature. And so there's nobody to sell those houses to, right? So it only works if you have a customer, right? Or it only when you have demand. So if when you cut that demand, well, then the supply, it becomes cheap.
Yeah, but
it becomes less
corporation,
expensive.
as a bank, you know what that's called? It's called a tax write-off.
Yeah.
We lost $5 billion this year they get tax write-off for the next 20
So-
years, you know.
So and that what that, that's what you saw is 2006 the houses were selling for 400,000. That same house by 2008 when after the bank had acquired it was only worth 250.
Yeah.
By 2009 it was only worth 175, right? And so even though the bank was like, cool, we got this house and we get to resell it, it was like, oh, wait a minute, that initial note that we pushed through, we just lost half of our money, and so that's where those losses, I guess, they took, and then you saw the bailouts, and because it was just that real estate continues to be, or banks continue to be that infused in our economics. It's huge, so. Yeah, so it's I think it's interesting, and obviously all this stemming from the initial point that Rohi brought up was 25% additional tax on flipping homes or home flippers, right? So let us know what you think about that. Is that something that is proactive in any way? And if you've been listening to us, I think the consensus is I don't think it is proactive. I don't think it serves a positive purpose. It doesn't create it doesn't create any opportunities, and it doesn't deflect any potential issues or solve any issues, right?
Correct, yeah.
And I think it. I stand firm on if you are going to implement something like that for the greater good of the people, right? Then more regulation is probably required or some type of standard. Now, on the flip side of all of that, right? So like devil's advocate, Rohi, like why would you want to slow this down? Well, to keep the investors out, right?
Yeah.
Because especially here in the Central Valley, and I've seen this in Los Banos 5 years ago, and it's completely consumed by investors now. It's a bedroom community, and now Madera is starting to get a lot of that action where people don't work here, they're not from here, they do business elsewhere, right? But they want to buy here. They want their wife, we'll just say wife, it could be a husband too. The wives are working now as well. But they want their spouse to live here, their kids to go to school here, and have a nice house. Very nice house relative to San Jose or Los Angeles, right? Because it's more affordable. They can afford that payment, and then they make the sacrifices and commute back and forth, right? Now, that's great. That sounds great. Why wouldn't we want somebody going and making Bay Area money coming and then spending their tax dollars here? If you're a local business owner, you're saying, heck yeah, I bring that money this way. But now if you're somebody who was born and raised in the lower middle class in Madera, your parents, they did really well for themselves, then they're homeowners, right? So they're encouraging you to be a homeowner, and they're trying to lift you up a little bit. But every time you go submit an offer, you're getting beat out by these cash money investors, right? And you want to buy the house that needs restoration because you have family and friends that know how to do all the work. But again, you keep getting beat out by these investors, right? Now, that's where I see the hurt. That's where I see people, really, just kind of down in the dumps saying, man, I can't afford a $300,000 house. I wish I could buy it for $200,000 like that investor did, right? Because I could have done that, and then, over time, I could have, built up that home.
But I mean, okay, take it to the extreme. If that's the angle, which I would agree that I don't like the perspective of these investment firms essentially like stealing the market, right?
Yeah.
So let's say let's go to the extreme, made it illegal for a non-person, like a non-single individual, to buy a home. Like if you're a corporation, you can't buy homes. If you're a hedge fund, you can't buy homes, right? That's illegal. So we left it to the home. It has to be an individual. Now you go to those distressed homes, nobody's going to buy it. I mean, yes, there may be that person that's all they can afford, right? They're looking at it like, well, I can only make especially nowadays, maybe a $1,500 home payment is going to get you this little 800 square foot crack that doesn't even have a roof, right? But that's all you can get.
Yeah.
I can see where it helps that person, but if at the same time nobody's buying it, and now, like you said, like now we just have this neighborhood of distressed homes that are just not selling because nobody has any interest, because you can't flip it because it's illegal to flip them now. There's no,
Right.
you can't be a business doing it, right? Like it stalls the market. Now, if the goal is, again, we want to make it legal because we can't say it's illegal for anybody to, buy a home, penalize those investors, penalize those people, not flipping the home, just say like when they go to buy that home, charge them that 25% tax. Say, hey, you're a corporation. On top of this house, now you have to pay this other tax.
Right.
That'll stop it, right? Because if they really think there's money to be made, they can pay it up front. So now when you and I are submitting a bid, here this home, they want $200,000 for it, but it's costing me $200 as an individual, but you as a corporation, you got that extra 25%. It's actually costing you more. You'll back out, right?
Right.
Our bids are somehow maybe a little equal, and I have that favor now.
Yeah, you make a good point, and I was trying to play, for the sake of the conversation, play devil's advocate and say, okay, let's look at it from the other perspective. But trust me, if you're an investor out there, don't think that I'm trying to make it harder for you. I want it. In fact, I think that what home flippers do is it serves a much greater good, because the reality is that same individual that says, yeah, I can do all that work myself and, sell me the beat up home and, whatever. Do you have the 200,000?
Correct.
Well, it's going to be no.
Yeah.
Okay. Now go get financing for that.
Yeah.
And the bank's going to say no. The roof has to be intact.
Yeah.
If you're looking at an FHA loan, FHA has a pretty elaborate set of guideline for the condition of a home, right?
Yeah.
If there's dry rot, any signs of dry rot, pest infestation, the carpet or the flooring, it has to be complete. If there's rips, if there's tears, if there's health risk, so like blood stains and whatever the case may be, which may sound funny, but these are the conditions that a lot of these homes are in. That's why these investors will cash for keys, right? Like they know that person's not going to be able to go list it on the market and then have somebody with financing come get it. It's a waste of a lot of time. So what they do is, hey, cash for keys. No questions asked. I'll buy your house right now for $200,000.
Yeah.
And the buyer, whoever's selling the house is like, yeah, this was my great uncle's house and it's a piece of crap and I don't want to have to clean it up. So here, take it. I'll take my money. You get people who have the cash money. They're not subjected to all the rules and guidelines that the banks are going to enforce on that first time home buyer. And they're able to get the job done a lot quicker because, again, I know there's several, there are several situations where that would exist where it would just make sense. Man, I can get that house for $50,000 cheaper.
Yeah.
I don't need landscaping. I don't need, maybe cosmetic stuff like that, right? I can paint the walls. Like, let me just do that, right? And that sounds great, but then we always got to look at those extremes, right? And when we look at the reality of the conditions of these homes, it doesn't fit the requirements that an average person or a first-time home buyer or even just a second home-time buyer, but somebody who's not an investor who needs financing is required to abide by. Right?
So I guess let me ask you this then, that since you kind of opened that a little bit. We have a distressed house, like you said, maybe there's a hole in the roof, it's inhabitable to some degree, right, of an inspection. Why should anybody be able to buy it? Like, you know what I mean? If that's the case, if I want to go buy it as a person, but you said the banks won't finance me because it's got a hole in the roof, shouldn't that be reflected in the price, right? I mean, doesn't that just mean that the price is incorrect because, well, we already know there's going to have to be $50,000 put into the roof.
Right.
Like,
so
isn't there something that makes that equal? Not to just say, well, you as a person, again, we're not going to fund you, but this guy's got cash over and he can do whatever he wants with it.
Yeah. So in that case,
like, what's the risk, I guess, to the bank if it's worth $100,000, $150,000 home?
Right.
That's what you're insuring as a bank, not, well, yeah, but you can't. It's got a hole and it's got.
So that would be so that's exactly what hard money lenders do, right? Okay. So there's traditional lenders who do all the Govy loans and conventional traditional loans, even subprime loans, right? But ultimately, all of those are going to take the homes well-being into consideration, right? Now, a hard money loan, that's a term that
Sounds like egg on C Street.
yeah, they're pretty close. A hard money loan is a term that if you're an investor, you're going to hear a lot, right? Or if you're thinking about being an investor or you're thinking about being a flipper, go get a hard money loan, right? Now, what's a hard money loan? It is hard money, right? They're typically, at the very minimum, they're going to want 10% down, right, up front.
Got to get on your knees.
So 10 to 20%. And then you're racing the clock because they're going to hit you with maybe a 10% interest rate, interest only loan. Yep. And every single month, you're paying them interest only, right? And so you're racing against the clock. And so that, kind of encourages you to complete your project quickly, right? But they don't care what the condition of the house is. They know you're going to go buy a hole.
Yeah, they're a loan shark. They're going to get their money.
Yeah, but they do, again, they do serve a good purpose, right? Yeah. Because who else is going to lend you that money? But now they do have a screening period. It's not going to be, you can't just go if you're just kind of an average Joe, right? Yeah. Now, if you are an average Joe, they might require more down payment, 25, 30% in some cases. But now if you come in and you say, hey, this is, you sit just like this. You're completing the application. Hey, here's my credit score. Here are my assets, right? Here's my plan with this home. Mm-hmm. This is where we're going to put on. This is when we're going to put it on the market. You sound like you know what you're doing, right? And oh, by the way, here's my portfolio. I own 4 or 5 homes. Yeah. And now you build confidence, right? And now they say, oh shit, man, we want guys like you to keep coming back to us because we like making money, on interest. So yeah, you only give me 10% down. The project's $300,000. Give me 30 grand, and we'll give you the $300,000. Go buy your house for $200,000 cash, and put the other $100,000 into it, and then sell your home, sell it, and then pay us back, right?
So why? I guess. In that regard, I mean, I get the home loan, like the hard money is a good for like the distressed home. Yeah. Why is it? I guess why wouldn't more people do it to maybe like just avoid some of the stuff that you would get with a traditional loan, just to get the loan and maybe refinance it later to pay these guys.
So people do.
Okay. So it's a strategy.
Yeah, it is a workaround, right? But it comes at a price, right? And I think the average person we're groomed to 30-year fixed, right? Is it a 30-year fix? That's the first question that Grandpa will ask you, right? The 30-year fix, that's all they care about. Yeah. What's the interest rate? And that's the second question. What's your interest rate? Okay. And that's about the extent of knowledge that the average person has, right? Let's get a 30-year fix and then make sure the interest rate's good. Mm-hmm. Even if you tell me I got a 10% interest rate, but that's amongst the lowest right now. Okay, well then that's good. They just want to give you a little bit, a little bit of guideline on that, right? But now. But these hard money loans do solve a lot of problems for certain individuals, right? Yeah. And I had a client who I actually just refinanced them into a conventional loan in January because last year he really wanted to buy a property. He needed to sell his current home, their current home, but they weren't quite ready to sell it yet. And so they just needed time, right? And so there are options for people like that, like a bridge loan and things like that, ways we could help them, right? But to your point, wanted to cut all the red tape. He just wanted the money. Yeah. He just wanted to go buy this loan or buy this home. He needed somebody to just give him the money so he could make it happen, right? He had like $50K on him, but that's about it. Mm-hmm. But that was again enough for whoever he went to sit down and say, okay, what are you doing? What's your plan? Okay, and then you have this property. Yeah, you have like, $200,000 of equity there. Okay, we'll do this, right? Because we know that you have assets, right? Yeah. And so they gave him this loan, and his monthly payment was $3,000 a month, interest only, right? $3,000 a month he was paying interest only. His mortgage right now, $3,100, right? $3,100 including his homeowner's insurance and property taxes, right? And so property tax, I think alone were like $800, right? And so it was like $2,100 for just his principal and interest. So he's paying principal and interest, and he's paying like $100 more than he was on that interest only.
Okay.
So if you're looking at it from a business standpoint, that is a bad business decision,
Sure.
right? Because he's losing money every single month, but it solved the problem, right?
Okay.
Now, if he was actually a business, he would have sold that house a long time ago, but he wanted to live there.
Sure.
And he was just kind of waiting out the periods for them to sell the other house, which we did. And, you know, a week after that sale, then he was able to apply some of those funds, and you know, and so we were able to refinance and get him much better terms.
Okay.
So that kind of is an example of like why the average person doesn't get a hard money loan, because those terms are that ugly.
Okay.
You know, in comparison to a traditional mortgage.
Let me say one last point, because then we're getting long, is, you know, the car industry, as prices kind of started getting a little out of hand, extended from a traditional 3-year loan to like now they get like 7 and 10-year loans.
Right.
Why isn't the housing market extending? Like, why, you know, 30, like you said, is grandpa's terms. Why isn't it 40?
Right.
I mean, I know that it sounds ridiculous, but so
Right.
does a 10-year loan on a car, right? Like,
Right.
why isn't the housing market seeing that breach of going to a 40-year loan just to help people with those payments?
Yeah, you know, and we will get to that. There are 40-year loans
Okay,
that
so
do
it is a
exist.
thing. It's
Yeah.
just, okay.
It's not your, so the 40-year loan.
Not that anybody, I think, pays over 40 years. I don't
Right,
think.
right. So the 40-year loan is right now being used as more of a loan modification, or like a tool to relieve a homeowner from their current monthly mortgage, right? So you see that when, you know, it might be your reality if you're out there listening. You know, monthly payment's just too high.
Yeah.
You're getting buried, right? And you're trying to keep up, but you're just a few $100 short, right? You can make your payment, but you're a few $100 short. You can speak with your mortgage servicer, and they could look into a modification where they add that 10 years or you know, they modify it over to a 40-year loan term, and they're just going to stretch out that payment over, you know, 60 more months, or, you know, 120 more months, right? An extra 10 years. And what that does is it saves you that few $100, and now okay, cool, now I'm good, right? Now the idea though behind that is, you know, to help you catch up. It's you know, it's set for 40 years. I mean, you have it there for 40 years, but it's ideally for you to, like, you know, eventually refinance when your situation gets better, right?
Exactly.
I mean, that's always the mindset you want to have, is use these vehicles for, you know, to help you get out of whatever slump you're in, right? And then go. But there are talks that, you know, even possibly FHA you know, offering this 40-year loan to help stretch out that payment, and it's becoming a little bit more like, you know, a thing with home prices continuing to go up, right? But at the same time, you know, it's like, I think it's all just kind of perception sometimes. It's like, you know, because when we're qualifying you, we're saying, you know, you can go up to 50% of your debt to income can be 50% of, you know, your gross income, right?
Yeah.
So if that's kind of like the way it is, you know, amongst everybody, even though that might be a lot for some people, it's kind of an equal like sacrifice that everybody's making, you know, essentially. But again, the idea is, well, make more money, and that helps. Or you can use some of those options to kind of decrease or prolong your mortgage, decrease your payment, wait for interest rates to go down, or of course, and always an option, decrease all of your other debts, right? And make sacrifices elsewhere so that debt to income can come down. So,
Okay, cool.
yeah. Well, hey, let us know your thoughts. You know, banking, or anytime government steps in and wants to, you know, add a tax or regulation, it always causes a buzz. And, you know, California, I think, does it more than anybody or any other state. And so that's kind of where you hear a lot of, you know, folks wanting to flee the state, you know. But, you know, in some cases, some regulations have proven to be, you know, positive, and, you know, other times, like in this case, we could agree that it might do more harm than any good. So let us know your thoughts, and we'll be happy to respond. And if Jose's out there on the golf course listening to us, we hope you get a birdie. All right.